Stablecoins. What are they? How do they work? And which is best? In this video, I'm going to be breaking down the three categories of stablecoins and explaining some specific examples, including Tether, TrueUSD, Maker, Haven, and many more. Hi, I'm Tom from Crypto Gurus, and if you want to learn more, keep watching. The first thing to say is that stablecoins have been a very influential crypto trend in 2018, and that will continue into 2019 as well. So if you don't already know about stablecoins, this is the video to explain it to you in very simple terms and break it down in a way which is easy to understand. Now we have to go through the quick disclaimer, which is to let all of you know nothing in this video is financial advice. Please pause the video now and read the disclaimer in full. Boring stuff out the way, let's crack on with the contents. And the first section, simply what is a stablecoin? The idea is very simple. It's a coin which is stable. Pretty self-explanatory, right? Most of them are pegged to a stable asset, such as US dollars, gold, euros, anything which we generally consider stable. With the majority of coins being pegged to US dollars, that means the aim for most stable coins is at all times for their coin to equal $1 US. Pretty simple. The interesting question is, why do we even need stable coins? Number one, they allow people to cash out of cryptos without having to go to GDAX or Coinbase and sell for relatively expensive fees. Number two, they have a practical use due to their low volatility. How about this? Would you really pay for coffee with Ether? You might say yes. Me personally, I'm going to go ahead and say no. Over the past 24 hours alone, Ether is down over 10%. I don't really want to pay with my Ether, which effectively means selling it, because of its ridiculously high volatility. A stablecoin is by definition stable, and therefore in theory can be used in the real world. Number three, increased global access to a stable currency. This point is absolutely huge, and it's something I'm quite passionate about and I'm looking forward to seeing in the future. Number four, the ability to use stable coins for collateral. Peer-to-peer lending is a great example. This is one use case of blockchain which seems so obvious and will almost certainly be very popular in the future. But having a cryptocurrency as collateral is pretty tough, once again, due to the high volatility. They can move up and down 20% in a single day. That is a lot of collateral to be devalued in a 24-hour period. With a stablecoin, you don't have to worry so much about this. Right, so we've covered what a stablecoin is and some of the use cases. Now we're going to move on to talk about the three different types. Number one, the fiat-backed stablecoins. Number two, the crypto-backed stablecoins. And number three, the algorithmically controlled stablecoins with no currency backing it. That's going to be a very interesting topic. But first up, we're going to jump in with the most common and simple, which is the fiat-backed stablecoins. A quick note here, the word backed and the word collateralized mean the same thing in this context. So if I interchangeably use the terms fiat-backed and fiat-collateralized, please don't be confused. Fiat-backed stablecoins are the most popular, with examples including Tether, TrueUSD, Altprox, DigixDAO, and many others as well. They are also the most simple, and they work like this. A certain amount of fiat currency, for our example, let's call it $10 million, is held in a bank account, and then they are able to produce tokens at a 1-to-1 ratio with the amount of dollars that they're holding. So with each stablecoin being $1, that would mean 10 million coins. The key here is that they have to be at a 1-to-1 ratio, and the money which is being held must equal the same amount as the coins which have been issued. So if we've got $10 million as a reserve, then the tokens which have been produced must equal a total of $10 million. At this point, I know you're wondering, but how do the coins remain stable? What if they go below $1 or rise above it? This is where natural market forces come into play. So let's look at those two scenarios. What happens if our coin now costs 90 cents, so it's fallen below its $1 peg? Well, as long as the project is fully collateralized, in theory, I could go and buy a coin for 90 cents and go to the project and cash it in for $1. I've just made over 10% profit very, very easily and very quickly. I've recognized this opportunity. Many other people will do as well. This will cause more demand for the coins, and eventually they're going to be pushed back up to $1. But what happens if the price goes above $1? $1.10, let's say. At this point, people should realize the project is no longer fully collateralized. Going back to our example, we have $10 million in reserve, but now the coins are worth $11 million. Now, people should see this risk and choose to sell coins. As they do so, this pushes the price back down until we return to a $1 peg. And once again, the project is fully collateralized, so it has become safe. That's how the market forces essentially mean that people should always be buying when the price drops below $1. They should always be selling when it's above $1. Therefore, we should roughly be at that peg at all times. Let's talk about audits. It would be amiss from me if I didn't stress how unbelievably important audits are for a fiat-backed stablecoin. Without audits, we don't actually know if the project is fully collateralized, and therefore it's always at risk. This is why I've been pretty critical of Tether in the past, because they have not had audits confirming they've always had the money. So if you're looking to pick a fiat-backed stablecoin, my one piece of advice would be only pick one which has regular audits and you can confirm that they are fully collateralized. Now let's cover the pros and cons. First up with the pros. Number one, they're very simple, very easy to understand, significantly more so than the other two categories. Number two, the collateral is stable. Remember, we're talking about US dollars here, and some people might say, well, there's high inflation rates, whatever. But when you're talking about crypto as the comparison, US dollar is very, very stable. And number three, no collateral is held on the blockchain. So in that sense, it is impervious to hacks. The cons. Number one, these projects are centralized as they rely on a custodian to hold the funds. This may only be one point and one critique, but considering we're talking about centralization in the crypto blockchain space, that's a pretty big point right there. And number two is that they can be expensive and slow when you want to liquidate into fiat currency. So you can't always easily convert your coins into fiat currency. It does vary depending on the coin, but that can be a general issue. Those are the fiat collateralized stablecoins. Now let's move on to topic number two, the crypto collateralized stablecoins. Crypto-backed stablecoins are very similar to the fiat alternatives, with the main exception that they use crypto assets as collateral instead of fiat currencies. So instead of using the US dollar, you might use Ether. That's the most significant difference. Some examples include MakerDAO, Haven, and BitShares. How do crypto-backed stablecoins remain at $1? It's the same market forces which applies to the fiat-backed stablecoins. There's no real difference in terms of those forces, so I'm not going to go into those already. I've covered those. Instead, let's run through a few questions which highlight the difference between these two categories. Question one, why? Why use crypto as collateral over fiat currencies? Crypto began with Bitcoin, and Bitcoin introduced the idea of decentralization and moving away from fiat currencies. By using a fiat currency as collateral, that kind of goes against the whole core premise of Bitcoin. Some people would say the space has evolved, some people say it shouldn't. It's a debate I'm not going to have here, but that's really the main point. By using crypto instead of fiat currencies, you create the separation from the legacy systems and you're not relying on government-issued currencies. Number two, how do they handle volatility? If you've been in the market for any time like me, you'll know that cryptos can go up or down, plus or minus 20% in a single day. Using that as collateral is pretty tough. It's not exactly stable. So how do these projects overcome that? What they do is over-collateralization. For example, if you want to use MakerDAO, you have to include 50% over-collateralization. What that means is if you want $100 worth of stablecoin, you have to deposit $150, that's an extra 50%, worth of Ether. That way, even if Ether falls, let's say 20% in value on that day, your $150 has gone down to $120, but it's still above the $100 threshold, and the project is still fully collateralized. Number three, why would anyone want to over-collateralize? Why would you want to lock up $150 worth of Ether? just to receive $100 worth of stablecoin in return. Number one, some of these projects pay interest. If you have no plans to sell Ether over the next 5 years, well, why not lock it up? Why not lock it up into this project, and then you can receive some passive income? You're not selling it anyway, you get your Ether back at the end. It's just some free passive income for a decision you've already made. Number two, the ability to create leverage. Let's say you lock up $150 worth of Ether, you get $100 worth of stablecoin. Now you can take that stablecoin and buy more Ether. You suddenly have exposure to $250 worth of Ether compared to your original 150. At this point, I want to say I don't usually offer recommendations on the channel, but I am going to recommend this time. Don't do this. Don't over leverage yourself. This is a market which has ridiculous volatility and is effectively leveraged already when you look at regular markets. Don't introduce leverage and end up getting yourself squeezed out of the market. That is not a smart way to go. The pros. Number one, these projects are decentralized. There is no trusted party you have to rely on to hold the funds. Number two, a separation from the current legacy systems and fiat currencies. Kind of covered that point earlier, so I don't need to go into it more here. Number three, transparency. Any good project should maintain transparency so everyone knows it's fully collateralized. As these are crypto assets, you can actually burn and create the tokens on chain so everyone can know for themselves that the collateral is being held. With fiat-backed stablecoins, we have to rely on auditors to go and do a job and confirm it for us. With crypto-backed stablecoins, in theory, we could confirm the collateral is there ourselves. The cons. Number one, these projects are very complicated. If you've ever tried to read MakerDAO's white paper like I have, God, you're going to know exactly what I'm talking about. There are sections which are still lost on me after reading it several times. Number two, risky. What you have to realize here is even though we have over-collateralization, crypto markets can drop by huge values almost overnight. So if a huge drop did occur and a project became under-collateralized, that is a big, big risk. And number three, these projects are capital intensive. You have to lock up $150 worth of Ether just to get $100 worth of stablecoin. We've covered fiat and crypto-backed stablecoins. Now we're going to move on to category number three, which is arguably the most interesting of all. Algorithmically controlled stablecoins with no collateral backing the project. With this category, there is no collateral used. So how do they maintain the peg? How do they make sure one coin is equal to $1? What they do is they adjust the supply based on demand. As we all know from basic economics, supply and demand meet in the middle at an equilibrium point. If you want to change the price of something, you can alter the supply that will move the equilibrium point and thus ultimately change the price. Examples include Basis, which have Basecoin, Fragments, and Carbon. We're going to be using Basis for our example. And when I say the term central bank, I want to make it clear there is obviously no central entity. This is algorithmically controlled. I'm just pretending that the central bank is making the decisions to kind of keep this nice and simple. So what happens if the coin loses its peg? It's no longer equal to $1. We won't have the same natural market forces kicking in with the other two types of projects because there's no collateral. So let's run through the two scenarios. It can either go above $1 or below. Let's imagine first the coin costs $1.10. It's risen above the value of $1. This one is pretty simple. The central bank can just increase the supply. They can make new tokens and then they sell them into the market. With this increased supply, this will eventually push the price back down to $1. And I want you to remember something here, which is that the central bank is selling to the open market, which means it makes profits. That's going to be important for what we talk about now. What if the coin falls below $1? What if it drops to 90 cents? The central bank can't simply unproduce tokens. That's impossible. Instead, they use the profits from the previous scenario. They go into the open market, they buy a certain amount of coins, and then they burn them. So effectively, they're reducing the supply to push the price back up to $1. At this point, you may be thinking, but what if they don't have enough money? What if they burn as much supply as they can and the coins still cost 95 cents? How are they going to push up the price then? This is where we introduce the concept of seigniorage shares. And that sounds complicated, Don't worry, I'll make it very simple to understand. Essentially, a seigniorage share is a claim on the future profits. So the project is going to sell seigniorage shares, they raise however much capital they need, they go back into the open market, they buy more coins and they push the value from 95 cents all the way back to $1. But why do people even want to buy seigniorage shares? What's the benefit to them? If the project is successful and continues to grow, there will come another time when the price of each coin rises above $1, and therefore the central bank can continue selling coins back into the market and making profits. The key here is that the people who have previously bought seigniorage shares are the first people to get these profits. So instead of it going to the central bank and them keeping it, they first pay people who have previously bought seigniorage shares. So effectively, by helping the project when the price was below $1, you get to cash in on profits when the price rises above $1. The pros. Number one, decentralization. This project doesn't rely on banks or any of the legacy systems, and it is truly decentralized. Number two, there is no collateral required. I had it as a negative that the previous type, the crypto collateral projects, were capital intensive. This is the complete opposite. We don't even require collateral. Number three, they don't rely on fiat currencies. So there is a complete separation from banks and the legacy systems, even further than I've just mentioned. And number four, they are the most ambitious. If a project like this is able to be successful, there are some huge implications, and I'm not talking about just in the crypto space, further reaching than that as well. The cons, along with being the most ambitious, they're also the most risky. The two tend to go hand in hand. They are experimental, complex, and arguably the most vulnerable to a rapid decline or crash, as they will almost certainly fail if they venture outside a certain limit of market behavior. They are based on formulae which is yet to prove itself in the open market. If you think about the global financial crisis in 2008, there was a lot of formulae used back then which people thought was correct, but it turned out to be completely wrong. Therefore, until one of these projects has been thoroughly stress tested and proved that it can work in the open market, I personally wouldn't be happy to put my funds towards it. And the final concern is what happens if the coin falls below $1, the central bank runs out of capital to buy more supply, and they aren't able to sell seigniorage shares. In this scenario, there is theoretically no way the price of the coin would ever return to $1. There are some methods which can be used, such as offering discounted seigniorage shares. I'm not going to go into detail there, but the threat is still a real concern. The first thing to say is that stablecoins are an absolute must. If we're ever going to see global adoption of cryptocurrencies, we need good stablecoins, certainly a lot better than Tether. Which type of stablecoin is best? This is a common question that is thrown around. It's not that simple an answer. Each one has positives and negatives. But I would break it down into three different time frames. Right now, if I had to put my money into any of the stablecoins, it would be a fiat-backed stablecoin. They're very simple, and as long as there are regular audits, we know everything is legitimate. Several years from now, crypto collateralized stablecoins have the potential to usurp fiat-backed stablecoins from the number one position. The only problem is, right now, cryptocurrencies are so volatile, they aren't a particularly good collateral. So that's why I think they are more for the future, but also hold more long-term potential than fiat-backed stablecoins. And the algorithmically controlled stablecoins could be the biggest, could also be the worst. Most of them may completely fail, while maybe one or two succeeds, and it could be bigger than the other two categories combined. We'll have to wait and see with that one. All I know is I will be following them very, very closely. Is there even a place for stablecoins in the market? It's quite an interesting question considering everything I've said so far. But what about when governments begin creating their own digital currencies, essentially just fiat currencies, but maybe on a blockchain in a digital form? You're probably thinking, but that's just another fiat-backed currency, it's just digital. You might think that, and I completely agree. But you have to stop and consider this for a second. I work full-time in the blockchain industry, and if you're still watching my videos a year after the bull run ended, you're definitely not the average person. If you go and ask the average person on the street, they don't really distrust fiat currencies because there's nothing backing it. They actually believe that because governments are backing it, that provides legitimacy. You might be laughing at this point and saying they are completely wrong. But at the end of the day, it doesn't actually matter if they're right and wrong. If everyone believes that to be true, the majority of regular people, that's how the market is going to go. There's only going to be a space for stablecoins if people actually want them. Inflation. With a stablecoin being pegged to dollars, it still undergoes inflation, so it's not truly stable. A true stablecoin would retain purchasing power over many years. Maker have actually discussed pegging their coin to a basket of goods to overcome this issue. It's kind of a crazy idea, and I'm going to be following that closely as well, because if they are able to carry that out, that is something which could be truly revolutionary. Perception. A stable coin will only remain at $1 because people believe that's how much it's worth. If people suddenly lose faith in one project, that stable coin could enter a death spiral and lose value rapidly. So that's an important point to consider when you're thinking about where to put your money to. Now I've got a question for you. Which type of stable coin do you think is best? I'm going to set the time frame here to today, not 5 years. We're talking about if you had to put your money into one type right now, which would it be? Vote in the top right now and have your say. If you haven't already subscribed and you've enjoyed the video, you're missing out on some great content. Hit that button down below. From Tom here at Crypto Gurus, thanks for watching. We will speak again very soon.